Hey everyone, welcome back to Corporate Decoder. Today we're diving into Cardlytics' latest annual report, so let's hope it's more exciting than waiting in line at the DMV, because some of these filings can be real snoozers. Think we'll find buried treasure or just more corporate paperwork. Cardlytics, that's the company working behind the scenes with banks to show you offers tailored to your spending habits. Their annual report tells us how they fared last year, if they made smart money moves, and what problems they see on the horizon. The report has some big numbers about who they work with and how much money they're handling. This year, though, they're showing a decrease in revenue, some pretty significant debts, and major expenses to write down the value of their assets. First things first, this is a Form 10-K, which is an annual report that public companies in the US have to file. It's basically a comprehensive overview of the company's performance over the past year. It includes everything from financial statements to risk factors, so it gives investors a pretty good look under the hood of the business. This particular report covers Cardlytics' performance for the fiscal year that ended December 31st, 2024. That means we're getting a full year's worth of data to analyze. Keep an eye on this number. It's like a unique ID for Cardlytics with the Securities and Exchange Commission. The report estimates the total value of the company's publicly traded stock, minus the stock held by people closely related to the company called affiliates, around $400 million. Cardlytics is pointing us to their proxy statement for even more details, specifically for information about executive pay and the board of directors. This means it's going to be filed shortly after this annual report, and we'll probably do a video on that as well. Alright, standard disclaimer alert. This section warns us that the company's predictions about the future might not actually happen. The company is using words like anticipate, believe, and expect. We need to remember that anything said about future potential is not a guarantee. Key to Cardlytics' success is to keep signing up banks, keep marketers happy, and maintain their current relationships. If they stumble here, it is going to affect the whole thing. Time for the stuff nobody likes to read, but is super important. The risk factors. This section outlines all the things that could potentially derail Cardlytics. It's basically a laundry list of potential problems. First up, the overall economy could cause serious issues. We are talking recessions, trade wars, inflation, and all the lovely things that make businesses and consumers nervous. Cardlytics warns that their financial results can jump around a lot from quarter to quarter. This is a heads up that they may not always meet expectations, which could lead to the stock price dropping. The big one, they are not sure if they can keep the revenue and sales growth going. Cardlytics admits they heavily rely on their main platform, hence the name, and they are at risk if it has any issue. If something happens to this, then it all can fall down. A huge risk is how dependent they are on a few banks. Basically, if they lose Chase, Bank of America, or Wells Fargo, they are in trouble. Cardlytics needs to protect their tech. They need to watch out for copycats, because if their ideas get stolen, they are in serious trouble. The company is letting us know that their stock price is unpredictable. It can be as jumpy as popcorn in a skillet. This section is where management explains their past performance. Let's see what they have to say about how things went, what they did well, and where they struggled. The company defines ARPU, average revenue per user, as the total revenue generated in the applicable period, divided by the average number of monthly active users. ARPU decreased by $24 during 2024 compared to 2023 as a result of an increase of $21 to $20 a result of an increase of $21 for fall-off. During 2024 compared to 2020, result of an increase of $21 that year and welcome back to 2023. As a result of an increase of $21.3 million in consumer incentives due to changes to their system. Here, Cardlytics gets into what it calls non-GAAP measures, which basically means they are not following a standard set of rules when calculating these financial figures. Companies often use this to show what they think is a more accurate picture, but we have to take it with a grain of salt and think about if we agree. Billings is the total amount Cardlytics charged their clients. Okay, let's check some key numbers now. Billings decreased by about 2% from $453 million to $443.433. Dollar by sales to existing marketers dipping $55 million gain, but was not enough to offset the loss. Revenue decreased almost 10% from $309.2 million to $278.3 million. That's a much bigger drop than billings, and they point to higher incentives. If they're getting less for every sale while dishing out more cash, then they have an issue with profitability. Adjusted contribution is management's key internal metric, and they define it as revenue less partner costs. For both years, we can check back to compare it with JGAAP's gross profit, which is very different. Let's take a look at the non-cashy adjusted EBITDA metric. Top adjusted EBITDA decreased to $2.5 million in 2024, a pretty big drop as it barely stayed in positive territory. That number was at $328 million in 2033. Digging deeper, we can find other metrics too. TAC to the company's adjusted net loss increased from $11.4 million to $18.9 million. It jumped significantly from $34.10. That loss, it jumped significantly from $34 and $7 impairment of goodwill and intangible assets. This means that they thought a part of the company's value decreased. Large to Pony 124 is primarily because they lost $31, because they lost $124 is primarily because they lost $139. Verity $9 and $300 one re 400 of goodwill and intangible assets. This means that they thought a part of the company's value decreased. Lastly, as an international company, it's worth noting the company has a section on international challenges. Looking at costs of running their business, we can extract and summarize a few important points in their business. In partner share and other third-party costs, there was a $1.3 million related to a commitment from 2023 that did not reoccur in 2024. But if you exclude this, it still decreased as the business deals, they renegotiated the contract with their FI partner. So their top line is affected and they are working to compensate that with other deals. If we look at future sales, it looks like most sales are short-term rather than having long-term. So it is difficult to predict future revenue streams in their own words. Let's take a quick peek at cybersecurity. They tell us that cybersecurity risks are among those that they address in their general risk management program and are managed and mitigated by various methods. Interestingly, the team is multidisciplinary, using a multidisciplinary team, including from our information security function, management, and third-party service providers, to assess how cybersecurity threats could impact our business, and some of it may be related to using AI for the business. It's a quick note that they have adopted an insider trading policy, a classic thing, but good to have. But as it usually happens, there is nothing else to report, and this was the end of Form 10K. Alright, so what's our take on all of this? This year's annual report was a mixed bag. On one hand, Cardlytics maintains some strong relationships with a number of large firms. On the other hand, it is dependent on a limited number of FI partners. It's walking a tightrope between dependency and potential opportunity. The declining revenue and billings are a red flag, and the company acknowledges there's no guarantee these will improve in the future. The high level of debt, coupled with the need to service those debts, will continue to be an albatross around their neck. There are some potential financial hurricanes. One bad storm could easily knock them off course. Their success hinges on their ability to innovate and expand their services. If they fail to adapt to the changing market, new competitors could easily swoop in. Overall, Cardlytics has potential. They also have a lot of work to do to get back on track. They need to show investors a solid plan for revenue growth and debt management. Thanks for watching, everyone. Please like and subscribe for more Corporate Decoder.